Welcome to the Property Couch, where each week you get to listen to two of Australia's leading experts. Bryce Holdaway, co-host of Location Australia on Foxtel's Lifestyle Channel, co-host of Escape from the City on the ABC, and partner of Empower Wealth Advisory. Ben Kingsley, chair of Property Investors Council of Australia and the founder of Empower Wealth Advisory, named the 2018 and 2019 Property Advisory Firm of the Year. Stay tuned as they bring you the insider's guide to property, finance and money management.
All right, folks, welcome back to the Property Couch podcast and welcome back to you, Ben.
Mate. So much to talk about.
There's a lot to talk about.
My head's spinning. There's just such a big program for today.
Yes.
Where do we start?
Where do we start?
I know. Where do we start,
No,
Bryce?
I'll take it from here. Don't need you to go anywhere. All right, get it over and done with. I had a listener reach out to me. He goes, I can't wait for Ben to bang on about Collingwood. So give us your best, mate. Come on.
I'm just so proud of the boys.
You've
Mission
used that
Impossible.
line before. Yeah, done that line as well.
Well, it's the
Got
truth.
any new material?
Yeah, I was talking to some people over the weekend, Bryce, who also reached out to me. In the final series, there's a lot of tipping competitions that you start. Basically, it's, last man standing tipping competition. So in the finals, each week you got to pick a team. And so, and they were talking about in their office in terms of how it all started. Well, at the end of the first week of the finals, there was 4 left out of 37. And that's because 28 of them picked the West Coast. But it was an amazing first round. I mean, it really was.
It was fun. It was good to watch.
Fun. The footy final, it does feel like finals time, and even though we're a month and a half late or whatever it feels like. But no.
It was challenging, the Collingwood game for me, because I'm a Freo supporter, so you don't want the arch rivals to win. Mm-hmm. But then I used to follow West Coast, so that toys with your head. And then if they lose, then you win, and I have to put up with this for the first 5 minutes of the podcast. So I was going through a whole range of emotions. But well done. I think I have to admit that that was the unwinnable final, and you won it. So well done. We're very, very blessed, Bryce, to have a fantastic team to follow with a now you're going on
win. With a win record of 60.97, greatest in the history.
You've done your homework.
AFL. It's unbelievable.
But you forget the stat that matters,
which is grand final wins. Yeah,
right.
We've been to the big dance far too many times.
And
not taken home the crockery or the silverware, as they say, the crockery, the silverware. But anyway. Look, it all means nothing if we can't show up again on Saturday night and keep going, right?
So, well, my son goes for Geelong, so I hope you don't go any further. But hey, mate, can't help but notice that you're looking a bit younger these days. What's going on there? Kenny Rogers, the royalties were getting into your bank account, and you've gone and shaved it all off.
As I said, I was going to, when we were in the severe lockdown. The plan was to obviously, let it grow. But we've taken
yesterday
a small step, Bryce, out, and that was enough for me to sort of get
yesterday. We had a meeting, and you happened to say, I said I was going to shave it off at the end of the month. And I quickly went to Ivis and I said, Ivis, can we go and review the tape? Because I'm pretty sure old mate said that he won't shave it off until we get out of lockdown. So we're frantically going through to see if we can find it. And I thought we'd had a spot to stitch you up, but then you did actually say you'll shave it off on the 28th, and you said that on the 24th, and which was annoying.
Oh, so in other words, it says to me you don't listen to what I say on the first run, right?
Well, not for the first 10 minutes, because you bang on about your footy club. So I'm like the rest of the
everyone's fast forwarded this bit anyway, haven't they? Right? They just want us to talk about property and
which we will get to. Hey, talking about property, Ben, I just want to flag that. I've gone through the Brains Trust, including your good self, and we are going to put on our very first webinar for the year, Ben. Now, the date's floated a little bit because of logistics of you and me being in the same building, given stage 4 and I'm in stage 3 and all those sorts of things. But we've now been able to lock in a date. It's Wednesday, the 28th of October, Ben. We're going to do how to build a property portfolio during a pandemic and retire on $2,000 per week without having to renovate, redevelop, or sacrifice your weekend. So stand by for more details. But what I want to do, folks, is Ben and I last year, we did about 6 of these.
Yep.
But in 2020, we've done donuts. We haven't done any. And so what we do is we actually do a live portfolio build, so you can actually see the numbers, how many properties, and how you can actually do it. So we give you a fair bit of information. So what I want to do is shout out to any of our new community that have joined us this year, and especially shout out to anyone who's been with us for a long time, Ben, but particularly those who haven't heard us talk about this podcast before, about this webinar before. What I'd like you to do is go to Facebook and like the Property Couch page, because Facebook and Insta is where we announce it first, where you can register. Now, we are very, very close to 10,000 followers on Instagram, Ben, so I'd love our community of Instagrammers who love Instagram, if they could go and support us there and follow us on Instagram to get us over 10,000, that'd be wonderful. And then on Facebook, we're chasing a milestone there. But the point for why you'd go and do that is that's where Stiggy puts the details up first, because there's only a limited amount of space that we can have in these webinar rooms, Ben, as you know. So if you want to jump on board and have a listen to that, that'll be coming up. So we'll give you more details on where to register a bit closer to the event, but put it in the diary. But the call to action today is just if you could go to Facebook or if you could go to Instagram and just go and follow or like us there, you'll be able to get the details. Another bit of housekeeping, Ben, is tonight. There's no footy finals. There's no major clashes on TV. So people can watch Escape from the City because it's my last episode, Ben. I did 9 episodes out of the 60, and tonight's my 9th up at Port Stephens.
I was going to say any sneak peek as to which location, but you're just giving it away.
You got to go and check it out, because
beautiful part of the world.
The first house, because where we were filming was close to the RAF base at Newcastle Airport, right?
Yeah.
And they were on train. And I've got to tell you, I have normally when you see those F/A-18s and all those amazing fighter jets, you just stop in awe and listen, and you can't, like, they disappear in a blink, and you kind of wish that your kids were around, they could come back. I can assure you without a shadow of a doubt, by the end of that day, I did not care if I never, ever heard another F/A-18 in my life. My ears were assaulted. We had to stop every 5 minutes to film because we just could not film. So, and there's a little bit of fun
with that. Is that like a blooper type thing?
Yeah. Well, Christmas tape's got some bloopers, but the actual episode tonight, we've cut around it, but you actually do see it. So check that out. And if you're listening to this podcast after Thursday, the 8th of October, I'd suggest you go to ABC iView and go and check that out, which is cool. And just a little shout out to a friend of the Property Couch, Leah Calnan, Ben, who is the president of the Real Estate Institute of Victoria. She's been a good friend of the couch, come on a couple of times. She was re-elected as president in the last week. So that's terrific news for her, terrific news for the stability of that membership. And I just want to do a quick shout out to her.
Yeah, so great work.
Yeah, absolutely. Well done, Leah. Hey, any housekeeping from you, mate?
No, speaking of milestones in terms of numbers, and numbers is what we're talking about today, and the changes that are going to occur, we think, in the market. Is it true that we've just ticked over 9 million downloads? Is that right? So
yeah, we're approaching.
Thank you
10.
to the community. We're approaching 10 million. Wow, that's fantastic. So
yeah, we got just on the iTunes platform, it's 9, Ben, but when you take into account Spotify and all the other places that people can stream us, do you know that iTunes have now got 1 million programs, not 1 million episodes
1 million
or 1 million downloads. There's 1 million separate shows. That's a lot. It's changed a lot since you and I were banging around back in 2015 trying to work this stuff out, but it's been a fun ride. Hey, my mindset theme today, Ben, for anyone who's joined us just recently, you won't know that I am going through the How to Win Friends and Influence People book by Dale Carnegie. For those of you that have been along the ride for the last 10 weeks or so, you'll notice that I've gone through and given some nuggets I've got some more today, Ben. Part 3. I'm in part 3. We've done part 1, part 2. In part 3, which is how to win people to your way of thinking. This chapter 11 is a sure way of making enemies and how to avoid it. And like every single time I go through this, the real gold is in the anecdotes and the stories that are within each chapter. And clearly, I can't go and narrate the book. I don't have permission to do that. But clearly, I don't want to take away that opportunity for folks to learn. So I'm still encouraging people to go and check it out. But here's a few key bullets that I picked out from this chapter, Ben, that I think will be helpful to the folks listening at home. So it's a sure way of making enemies and how to avoid it. So you can tell people they are wrong by a look or an intonation or a gesture just as eloquently as you can in words. And if you tell them they are wrong, do you make them want to agree with you? Question mark. Never. They never want to agree with you, for you have struck a direct blow at their intelligence, judgment, pride, and self-respect. That will make them want to strike back, but it will never make them want to change their minds. You may then hurl at them all the logic of a Plato or an Immanuel Kant, but you will not alter their opinions, for, Ben, you have hurt their feelings. Important point to know.
It is.
So never begin by announcing, I am going to prove so-and-so to you. That's bad. That's tantamount to saying, I'm smarter than you. I'm going to tell you a thing or two and make you change your mind. So this is a challenge. It arouses opposition and makes the listener want to battle with you before you even start. It is difficult under even the most benign conditions to change people's minds. So why make it harder? Why handicap yourself? If you're going to prove anything, don't let anybody know it. Do it so subtly, adroitly, I don't know what adroitly means, I'm just quoting, that no one will feel that you are doing it. Good advice. So over 300 years ago, Galileo said this: you cannot teach a man anything. You can only help him to find it within himself. As Lord Chesterfield said to his son, be wiser than other people if you can, but do not tell them so. Socrates said repeatedly to his followers in Athens, one thing only I know, and that is that I know nothing. So if a person makes a statement that you think is wrong, yes, even that you know is wrong, isn't it better to begin by saying, here we go, here's the wisdom here. Well, now look, I thought otherwise, but I may be wrong. I frequently am. And if I am wrong, I want to be put right. Let's examine the facts. You'll never get into trouble by admitting that you may be wrong. That will stop all argument and inspire your opponent to be just as fair and open and broad-minded as you are. It will make him want to admit that he too may be wrong. So principle number 11 is this: show respect for the other person's opinions. Never say you're wrong. So Ben, if I do that, I have to go. I think I'll go. Well, now look, I thought otherwise, but I may be wrong about Collingwood. I frequently am. I find that hard to say. And if I'm wrong, I want to be put right. But let's examine the facts. So there you go. There's a little bit of wisdom there, Ben, from Dale Carnegie, written back in the 30s, about not trying to tell people they're wrong, because you will never win that argument. So there you go.
That's right. People will tolerate other people's opinions and conclusions, but they'll only act on their own conclusions. So that is very, very true. So, mate, I love that stuff. Keep it coming. Keep it coming.
Check it out, folks. Dale Carnegie's How to Win Friends and Influence People. Over 16 million copies have been sold, Ben. That's a lot.
It's a lot.
We're at 22,000 for our book, so we've got a bit to go. But hey, today we want to talk about obviously the budget that was a little bit overdue.
Yes.
And also have a bit of a flow-on discussion of what that means for the property market. And if we get some time, we might have some questions from listeners if we get some time. But there's a big agenda today.
Huge agenda, and you know, the main thing we want to talk about is obviously how do we get out of this health crisis and move into solving the economic crisis. And we realise that we're obviously still in the pandemic, but what we also realise is in watching the sentiment movements that are occurring in different states, and the activity and the spending that's occurring in different states, we're getting clues, Bryce, around people's tolerance and better understanding of this. Now, if you were to go back and play some of our episodes in March and April, when there was a lot of uncertainty and the like, there was a lot of pessimism and fear and scaredness in terms of, you know, what was happening. And the reporting of that time, you can now see the changes that are occurring in terms of the reporting. Now, that said, if you had have tuned into any of the budget announcements, there was still a flavour in the mainstream media of, oh, wow, that's a big deficit, they're big numbers, who's ever going to pay for this, and those types of things. But my question to you, Bryce, is did the government really have an alternative? Was there a choice for them?
No, no.
No. So with that in mind, we've got to now start to think about people's tolerance towards the risks that they're going to take. Now, again, we've been relatively consistent in the sense that there's a lot of people who have been impacted unfairly, like through no fault of their own. They find themselves in a terrible situation, whether it be their employment and also in a lot of cases, their health. So that we'll never lose sight of that. But for the vast majority of the population, as mobility starts to come back, and we are starting to see sentiment shift, and we see significant war chests in a significant amount of households, we're in a position now where we can probably see people wanting to take on a little bit more risk, and that also correlates to the health crisis. So if we do have some significant flare-ups in the end of this year or next year before we see a vaccine, we're going to obviously, potentially have more work that needs to be done from an economic point of view, whether that be monetary policy, which we've seen the RBA do, or fiscal policy. So I wanted to start, Bryce, with just a couple of the key measures, right? I'm not going to get into all of the what's in it for business, what's in it for the others, but I wanted to start off by just talking about, what is in it directly for property. Obviously, prior to the budget, we saw the 670 million home builder package that was released for new builds, renovations, and that ends at the 31st of December. Now, the government is still taking on notice how much of a take-up of that program, but we definitely are seeing from the industry who specialise in the building sector and the construction sector that where there is open mobility, Southeast Queensland and also Western Australia, namely Perth, this has been incredibly successful in addition to the first homeowners grants and all the other bonuses that are being delivered at state level. And we are seeing, tradies reporting and builders reporting that they've got a pretty solid book. So that has done its job in terms of moving demand forward. Mm-hmm. In cities and states like Victoria, and also New South Wales, a little bit less of a pickup. And, Melbourne's got a good reason why. For you to put your paperwork in for your application, you need to get potentially surveyors, building inspectors and those types of people out to the property, and they haven't been able to go out there. So you'd like to think that the government may do something for the Melbourne community around that job builder package, and there might hopefully be an extension or a focus in helping Victorians in that particular space. The second one, Bryce, was the home deposit scheme, the extra 10,000. You want to tell the community about that one?
Yeah, well, it's just an extension of a program that they've had for some time, but I think the feedback from that is clearly it's for new builds, which there's a clear multiplier effect of new builds. So I understand the economic theory of why they would do that. So that because the multiplier effect of a brand new house has so much more economic expansion or growth potential than someone buying an established home that might employ a real estate agent and a building and pest inspector and a conveyancer and all those sorts of things. But I think from our perspective, because what we certainly like to teach first home buyers is to make their first purchase the first step on the property ladder. So by not being able to get established, the first step on their property portfolio journey,
Yep.
So without them having access to established, I think they've got to be a little bit creative on what that first property needs to be in order for it to be a long-term keeper versus getting into some products that we don't necessarily think make for a great investment, but they make for a terrific shelter, but they don't make for a great investment. So that's probably, from the property perspective, it would have been nice to see if we could have got that from established, but then I think they would have had a line up to the wazoo for those 10,000 spots. So, but I get why they did it, but it would have been nice for it to be established as well.
Yeah, and it's effectively less than sort of 10 to 15% of the marketplace. So it's not going to have a material impact in regards to those people who, and I think, what we're saying is, don't be tempted to put your 5% deposit into a house and land package out wide if there's a lot of vacant land out there and so forth. Now, we're going to
get underpinning demand on it though too, if you think about it too, Ben. It's like if you've got a stack of dominoes, imagine you've got a red domino and 6 black dominoes, and the red one just indicates the firsties. So you lift up the stack, put the firsties on the bottom rung. All of a sudden, it puts the pressure up the line as well. So it does have an upward pressure on price in an environment that is incredibly low stock. And you said before, let's go back to March and April and some of the conversations we were having back then, and we talked about some analogies around the car and just can't get the drivers in and low stock. But it is. I can assure people listening to us that we're not buying just in Melbourne or Geelong. We're buying all across the country, and without a shadow of a doubt, not only are we competing in enormously strong interest across a whole range of price points, Ben, including entry level right up to seven figures. So not only that, but there's just multiple groups through multiple offers.
Yeah.
We have to be incredibly creative just to jockey to get ourselves into position 1 or 2 to secure the property. So there is an enormous amount of demand. So again, when you've got low stock, increasing demand, and quite often people think, well, why is property so resilient given the fact that we've had such an X factor shock event? It's not easy to trade. It's not liquid, but it's an essential need. And typically in this country, people will scrimp and save on nearly everything before they miss making their mortgage repayment. So it kind of makes sense, doesn't it?
It does. And so more than ever, we want everyone to not focus on just the incentives, because if that property doesn't grow over the next 3 or 5 years, now there will be a rising tide lifting all ships. We're going to get to that part in the second half of this episode where we really are going to showcase where we think the ducks are lining up, and also still some challenges and some risk, but the ducks are definitely lining up for this next phase of rising tide lifting all ships. So we'll come to that in the second half of the podcast. In terms of, I want to keep the focus still on the budget for the moment, because some of the key takeaways of this, right? The economy is going to decline by 1.5%. So this is Treasury's forecasts for the current financial year. So for the 2021 year, we're talking about negative 1.5% growth, obviously on the back of the 7% decline that we had in the first half of the year. Now, some economists are forecasting that we will see a positive September quarter, which is great. Most thought with the lockdown in Victoria, we might stay in a negative quarter. But, so Bill Evans from Westpac is predicting around a 1% GDP growth for the September quarter, and then moving into growth in the December quarter. Pretty much everyone's sort of thinking if we can come out of lockdown, we'll be in growth at least by the second quarter. So the recession technically will be over at that point. I want to move into the forecast for 21-22. Treasury are forecasting a 4.75% growth story. Now, that's on the back of a bit of clever, what I think is a very clever piece of legislation that they've introduced, which is around the instant write-off asset for businesses up to $5 billion, which is effectively 99% of all businesses in this country. Now, one of the things we've always talked about from an economic point of view that we do need to see as an economic indicator is business investment.
Yeah.
And if you don't get that business investment, it's really important for that trickle down or flow down effect in terms of, okay, I'm investing in the business, which means that means I'm going to go out and get more work, and if I'm going to get out more work, I need more staff to do that work, and that obviously goes down into jobs. So
it's a similar effect to home builder, isn't it? Because it's not only they're employing more people,
correct,
but you're buying more products, and those products have got to be from businesses that employ more people, and then you have that multiplier effect in business that you have in new construction.
Yeah, and it is that float. I mean, I was even talking to one of our partners who's got his own private company, and he's basically said, "Oh, time for a new car." And it's a perfect time for that. So there's close to $30 billion that's going to be potentially projected. Now, what is good about this type of policy, Bryce, is if it's used, then the economy moves forward. If it's not used, then it doesn't cost us anything. Yeah. So as opposed to, say, giving businesses tax cuts, which really, once they're in the system, you've got to keep paying for those forever. And that's a risk that is not really worth taking at this point in time until the economy is really flying, or there's competition globally for talent or businesses to set up in Australia as opposed to setting up overseas. So there's a lot of good measures in this budget that are really short-term measures that don't carry forward indefinitely. I mean, they did avoid the social housing calls and the pressure there, and I think the Labor Party will do the right thing, for their constituents in terms of calling for social housing. But the challenge with social housing, and again, with 430,000 people on waiting lists, something needs to be done for affordable housing. We are all for affordable housing, but you put that money in and you've got to keep sustaining those properties, keep renovating and upkeeping those properties. There's a lot of compliance work, especially if you're in government. So that is an ongoing cost. The same sort of thing about their hesitation to increase the unemployment, the job start sort of amount, Bryce, because the way in which the Liberal Party look at it is the best form of welfare is having a job, because it also means purpose, and you don't have the idle mind. So they're hesitant in basically lifting that too high, where it doesn't stimulate people to go out and get work. And we've seen a little bit of that show up in terms of job seeker, because that payment has been so high. And we're hearing people ringing up saying, I've got some work for you. They're sort of saying, look, I'm all right at the moment. I've got enough money coming in. So you've got to get that balance right between that. And I think that's ultimately what they're looking for in this budget. So that was the big one in terms of GDP. So if we get the virus under control, and this is where looking at the World Health Organization, they're currently monitoring 8 vaccines, 8 that are in stage 3 trials. Now that is like, if we get an announcement there, people will be potentially prepared to take on a bit more risk if they think that they're going to get their mobility back. And so that will be a positive news story whenever that starts to shape up. Now, this budget assumes that a vaccine won't be ready until the end of next year, not the middle of next year, but widely available to the end of next year. And I think that is a fair assumption. I don't think it's an ambitious assumption. I think it's a fair assumption. So with that in mind, unemployment. I just wanted to talk about unemployment. Have you got the unemployment figures there, Bryce?
Yeah, so Treasury says 7.25, but Westpac said 7.9.
So in terms of the unemployment, what we're talking about there is 7.25 at the end of 2021, and then 6.5 in terms of 21-22. That's the Treasury figure. Some of the economists don't quite have that as a bullish number, but I suspect that the last mile we've always talked about is going to be the hardest mile to get. But if we do get the unemployment rate and the participation rate up, and the underemployment moving in the right direction, that is very healthy for the economy. It's very healthy for tax receipts and getting that stimulus moving forward. So they're the 2 big numbers we want to look at. And then the final thing we wanted to talk about from a budget point of view, before we move into a more focused story around property, is the story around the tax cuts. So the personal tax cuts. So we had sort of put a little rumour out there that we thought that it might be 1 January, that they might bring those tax cuts forward. But no, they actually have backdated them to 1 July, which we think is also an excellent decision. Now, I just want to put this into context for our community, because it can be a little bit sort of, what does it really mean? Well, effectively, if you have an income of $40,000, your tax liability is going to drop by 21.4%. Now, that's a change in tax payable of $1,060 over a year. If you've got $80,000 as income, then you've got a saving of $2,445 or 11.3%. You would pay 11.3% less tax. If you've got $140,000 a year income, you will save $2,565 or 8%. And I'll round it out with the $200,000 one. And we'll put this table into the show notes because there's a lot of different layers there. But $200,000, you're only getting a change. You get $2,565, but you only get a change in your tax liability of 3.8%. So it's a scale tax system. It's how we've been operating for a long period of time. So the greater percentage change is obviously for the lower income earners. And then as you move up the scale, the percentage change drops and it really taps out above that sort of 120,000 at an overall saving of $2,565. So that's
So
more
Ben,
money.
on that, the difference between 80,000 and the higher income earned is they'll get an extra $120. So
Correct.
so it's actually not giving the rich the money back. But there's an important thing here too, is that if you're not paying that extra, call it on $80,000, you're not paying that extra 2,445. It's actually coming back in your pocket.
Yep.
If you're a property investor or you're considering being a property investor, the negative gearing benefits won't be as much because you won't be getting as much tax back. But it's important to remember you're getting an extra $2,445 in your pocket. So you've got a choice to make. If you still want to self-fund at that sort of income level, would you still mentally, prior to these tax cuts, you would have been getting that tax back and putting it towards your future? So that's something for you to think about. Okay, you're now getting it back in your own pocket, and it will feel like it's been taken out of your own money. But essentially, if you keep your eye on the prize that you want to self-fund your retirement, climb the mountain that we always talk about, scale it to the top of the summit, and get 2,000 a week or whatever it is for you. Have a think about what that means for your family cash flow to still putting that into property. Ben, I remember back in 2000, I've said this story before, but I'll refresh that we used to, when I was involved in helping people buy properties since October of 1998, Ben, which ages me a little bit. I know what you're thinking. I don't look old enough. Well, with the grey hair I do now, but at the time on the 30th of June when we went into GST, they made significant tax cuts as a compensation for the GST. And all of a sudden, when every property that we were presenting to a client was always positive cash flow back then, Ben. $7 a week, $11 a week, always positive cash flow. And even then, people still had mental hurdles to overcome. And I remember doing the analysis just pre 30th of June when those changes came in. And I remember running the same properties through, and the tax cuts were actually in. And instead of getting $7 positive a week, we were $10 negative a week that we had to pay. And I remember at the time thinking, and this is how green and naive I was, I'm thinking, no one is ever going to invest in property ever again. I mean, they've gone from $7 a week in their pocket to now taking $10 a week out of their pocket. This is just madness. No one will do it. And clearly history has shown that there's something bigger than tax cuts involved or tax savings involved in investing in property. There's a much bigger agenda around self-funding your retirement. But in my ignorance and my naivety at the time, I thought it was the end of investment property. So that I tell that story because clearly at a time like this, those sorts of things will come into people's heads.
Well, it's worth double clicking on that, Bryce, and talking more about negative gearing. And we've always been really consistent that it is not an investment strategy, right? To run a property at a loss, on the hope that you get a gain, and to be sold as that's the main reason why you invest in property, you've got rocks in your head. The fundamentals need to be around the scarcity of that asset and the future capital growth, which will occur in the land. Remembering that's the piece over the long term that grows in value as the improvements on the land, being the house or the townhouse or the flat or whatever, obviously deteriorates and depreciates over time. So it's a nice little segue into why we do think that there will be potentially more people looking at property, Bryce, as a means to create a retirement that's meaningful for them, because we do know that with historically low interest rates, that also means that the yield that you're getting on the property and servicing that debt also comes down. So not only are you getting a kicker from the tax man in terms of having more disposable income, what's also happening here with record low interest rates is that servicing that debt also becomes more accommodative, and people are saying, well, I'm not going to leave money in the bank. We've seen really strong results in a rebound in the equity markets because people are sort of saying that, why would I put money in a term deposit, or why would I keep it in a high interest savings account when my money's not working as hard as it could be for me? So that is one of the catalysts that we have put on our list here in terms of why we think demand will continue to grow, because with the lowering of the interest rates, you're going to see, more properties being easier to maintain and hold, and that's where the rising tide is going to lift all ships. So I'm glad that you brought that up as a conversation point, Bryce. So we believe in buying existing property over new. We don't believe, that new is best. We're obviously always a big believer in location. Does 80% of the heavy lifting. And if you're buying that existing property and you're doing the tidy ups and the renos, well, you get the depreciation, because under the current legislation, you cannot get depreciation from an existing property unless you're acquiring it new. And so that does also bode well for, sort of people going, wow, I mean, if there's, yields of 3.5%, but my interest rate is only in the low threes or late twos, or in some cases, we're even seeing interest rates in the low twos. That's the sort of conversation that's going to be had in households when they're sort of saying, well, maybe one investment property, maybe two investment properties might help us in conjunction with our super to be in a better financial position.
Absolutely. I mean, demand drivers, there's a couple of things. One's population growth, household size, and the ability to buy.
Yep.
And that ability to buy is measured by interest rates. Well, that's heading south. Yep. Household income. Well, income's cash flow is just about to get an injection through these personal tax cuts, which will flow through to owner occupiers. I'll get you to talk about bank credit policies shortly in context of responsible lending reforms.
Sure.
And then the last part of that ability to buy is around relative returns. And you've talked about that in terms of the comparison of, do I put it in the bank versus putting it into property? That's just on the demand side. Sure, population growth is taking a temporary hit, and that will be a factor, but the planes will start landing again next year. But then on the supply side, well, the construction is diminished, so and they're trying to put stimulus into kicking that off, and then existing stock. I'll tell you a little story. I'm helping my wife's auntie put her property on the market in a lifestyle suburb here in Melbourne. We've gone through the process of choosing the agent. I've been chatting with the agent, and I can assure you, it looks like she might get a bonanza price. Ben, just because of the amount of stock, the price point, and the fact that there is, according to the agent, he put a property on the market at 880, eventually sold for 906, and 3 underbidders who automatically will go and have a chat with my aunt, Andrew's auntie, and then bring some more people in the mix. So that is just happening. That's just one little microcosm of one property on the market, but that is just reflective of what's going on in particularly East Coast Australia. So it's very as a team of buyers like we are, it's certainly like that to be a little bit more balanced, because it's good for all the existing property owners are all licking their lips, but the folks who want to get in, there's certainly, let's just say that it's certainly not a case of supply exceeding demand by any stretch.
It's going to be a boom and bust story again here. I mean, and this is what's happened. So we'll go through our series of where we think the ducks are lining up, and then we'll talk about some of those risks and challenges, because it's not all going to be smooth sailing. But in terms of if you took a snapshot of interest rates from the early 90s, right, where households were paying retail rates of 17, 18%, right, and you followed that chart down to where households are now paying 2 to 3% for interest rates, there is an index curve that just completely goes in the other direction, and that curve is, and what we've been talking about for a long time, is borrowing power. And what that has been able to do is it's lifted the value of properties over that time, because people have been able to still, at reasonable income to debt servicing ratios, be able to buy those properties. Now, owning your own property, having your own property is an aspirational thing in Australia, right? We call it the Great Australian Dream, but there's this, sort of inversion curve that happens in regards to rates values moving higher has very much been a product of double household incomes and then record low interest rates. Well, we're here again, where we've seen interest rates move from the 5% now down to the 3s and 2. So we're going to see this uplift, and it's classic because, Bryce, there's a formula out there that most economists use, and it's referred to as fair value. And it's how an economist will value a property in terms of fair value. And fair value is the rent divided by the user costs less capital appreciation, right? So in other words, the theory goes about it like this. Why would I rent a property when I can own it for around the same cost? And that's what we're going to be seeing here in terms of this debate, because if rents still remain reasonably okay at that yields of 3 and 4%, we are going to see that have a ripple effect throughout the economy, where we are going to see potentially lower end property prices in regional areas and also potentially city fringes or whatever, where there might be an outperform. They may actually, in the short term, 3 to 4 years, actually get better percentage growth because there is going to be demand for those. And what's interesting about this particular term compared to, say, the boom that we had through 14 to 17, Bryce, is this is really owner-occupier led. This is firsties back in the market because they can feel they're back in the market, and it's less investor-led. So we definitely haven't seen the investor finance numbers starting to turn, and a lot of that investor finance was sold into medium and high density product, and that has underperformed significantly, and now is obviously one of the only risks really in the property market at the moment because of low rental demand for that accommodation and also oversupply of that accommodation. But freestanding properties or suburban properties where there's a good blend, a mix of a variety of property, that is the marketplace that's going to be interesting. And then we look at areas like Perth where the market has underperformed for that same period of time as the mining boom finished. What we've actually seen there is the first movers in that market have actually been the higher end. And we'll start to see that ripple effect start to take shape in that Perth market over the next 12 months as it moves into positive growth. And it also has pretty low vacancy rates at the moment. So it's those types of economies. Southeast Queensland is another one that's of interest to us in that sort of affordability price belt where we will see some strong movements in price, we suspect, over the next 12 to 24 months. And that's on the back of, number one, the economic recovery that we are seeing. Still some, there will be still about managing the outbreaks, but opening up the economy, opening up borders, seeing people and mobility, people taking holidays and hopefully getting more employment into those areas, construction moving, retail spending is hopefully going to also spike, remembering that 60% of our GDP is in consumer spending, right? It's in what we spend as people. So we are ultimately going to write this story. The economy is only it's a record-keeping exercise of our activity. So the government, through their budget, is trying to stimulate spending, and they're putting more money in our pockets, at obviously in terms of business investment and also at that personal level by giving us those tax cuts.
So Ben, do you want to give a little 101 on the responsible lending reforms and how that might impact our listeners in terms of getting access to credit, how freeing up a bit of that access to credit once we know the money flows, that obviously puts extra demand into property as well.
Yeah, so Bryce, post the GFC and basically free money, no income, no jobs, just approved or just assets, right? That was the backdrop of why we introduced or the government introduced responsible lending. So the onus moved away from basically the lender was then responsible as opposed to the borrower being responsible. So what we've found from that is the government, in addition to that, obviously the Royal Commission, and we're now starting to see best interest duty being proposed for mortgage brokers, which will either take effect at the 1st of January or it might be pushed down the road a little bit. But the whole idea of responsible lending meant that there was a lot more scrutiny on the assessment of a loan that was being put up to a bank. And effectively the banks had the responsibility to do a detailed investigation. And there were classic cases, obviously, the Wagyu beef case, where Westpac was taken to court in regards to not doing enough investigation and just using what we call a standardised HEM index, which was, this is basically the general spending of this household composition. So we're just going to use that to assess the lending and approve the loan. So ASIC, under the responsible lending laws, took Westpac to court, and the judge ultimately found in Westpac's favour to sort of say that that really Westpac didn't do anything wrong, and that was that a lender would actually change their spending behaviours and not eat Wagyu beef and wash it down with a nice Shiraz. Instead, if they've got a debt, what they would do is they would reallocate their resources to service that debt and reduce their spending on discretionary items such as Wagyu beef and Shiraz. Now, I think this is a sensible move because it puts the onus back on the borrower, which I think is fair enough, because borrowers could basically tell the banks anything, and if they missed it in their investigations, it was it was all the bank's fault. Borrowers need to be held accountable. I mean, I've always been a critic of regulating to the lowest common denominator. I think there's some good things in the reform package, which for payday lending and personal credit, short-term personal credit, and some lease agreements. I think there are some susceptible people in our community and vulnerable people in our community. That stays. So we won't see any of that greedy, sort of payday lending going on. I think that's good. But coming back to the point, what's ultimately going to happen, Bryce, is when someone puts their application in, if anyone's been listening to our series each week, you would have heard us say for the next 3 months, you've got to be really careful in terms of what you spend your money on, because the banks are going to judge everything that you spend, and they could decline your application because you've gone and bought a handbag for a 20 wedding anniversary for your wife, and they're assuming that you're going to keep buying a handbag like that every year. Right, and so all of a sudden they've assessed your spending at a higher level, which means you can't borrow the amount that you needed to borrow. So why is this a positive? It just means that we're going to see applications going in. The bank is still going to do their vetting because they're still going to be accountable to APRA. So APRA are still going to have the levers on the assessment rate, and that assessment rate does also influence the amount that you can borrow. But I just think with best interest duty coming in, whereby we need to make sure that the lending that has been recommended to the banks is appropriate for the borrower. And we've also got APRA as being the cop on the beat, making sure that the lenders aren't getting too aggressive in their servicing calculators. We're going to see more credit flowing through. And more credit means more people pre-approved, which obviously then hits demand side, and that could put a little pressure on property prices, especially also when they may be able to get a little bit more borrowing power because they've used a standard assessment as opposed to looking at the individual spending of each applicant.
Very good. So let's bring all this together for the listeners, Ben. We've obviously had a budget that's designed to bring us into a position of strength. We used the car analogy back in March around the government's at the fuel bowser pumping money in. They're continuing to do that to try and prop up the economy. Yep. We've still got interest rates really low. So the analogy around having the car fully tuned is still there. And look, the net result is that we will be paying off a debt for some time based on the way that they're spending it. But it's really just a case of playing to win rather than playing not to lose, isn't it? Because if we play to win and we spend the money, sure, if you look at the big number, it can look scary, and that'll get a lot of headlines, and that's what a lot of headlines came from the budget. But we have to move into a position where we spend money to make money, because like we've said earlier, if we don't generate the multiplier effect of getting underlying confidence in business, we won't be able to get underlying confidence in jobs, which therefore we won't get underlying confidence in household incomes, and then that'll become a snowball running down the mountain in the wrong way. So I guess the summary from our perspective, from a property point of view, is that ultimately our sentiment hasn't changed from when we were chatting about this when the pandemic first started. And now there's evidence to suggest that not only will the property market not reach some of these Armageddon lows that some of the headlines made at the time? And we teach our audience to not tap into generalized statements. So I'll be mindful not to make a generalized statement. But if people were to understand the fundamentals of the types of properties that we recommend that people buy, based on all the evidence that we have talked about in the last 40 minutes or so to support that, it still remains an asset class that can give you confidence not only to invest now, but also for the remainder of this decade. Because back in March, we talked about on the very first episode that we kicked off when the coronavirus was at peak anxiety and peak powers across the economy, as we said that the 20s, based on the amount of demand for people that are coming over here, will likely be the best decade for people to accumulate residential real estate. So if we were to rewind and go back there, Ben, you'd find us very, very consistent in the message. If your job is secure and you want to self-fund retirement and you believe in a get-rich-slow scheme, it still is a very important vehicle for people to consider, and there's no evidence to suggest that it's overtly risky at the sub-headline level that we talk at, not at the headline level.
Yeah, I think so I mean, that's a nice segue into one of the other big sort of pessimistic talking points in the economy, and it's probably one area where I'd like to see the government do more, and that is the immigration story, right? I think there's a political element as we move into an election year next year where they want the economy moving, but they don't probably want to give Labor any chance of sort of saying, oh, these immigrants are taking, whereas we know that is an absolute fallacy, but it still resonates for those people who don't think about it more deeply in terms of everyone who comes here buying things, and that creates jobs, right? So I suspect in stealth, the moment that we see those vaccine programs coming in, we'll start to see those foreign students and those visa holders and those immigrants start arriving in better numbers that have been forecast. We saw in the Treasury estimates in the budget there that they are expecting that the population growth will only grow by 0.2 of 1% in 2021 and 0.4 of 1% in 21-22. Now, I would suspect that if we have a vaccine by the middle of next year or slightly earlier than that, that who would get access to those vaccines potentially could be students coming here. Anyone who wants to travel, I suspect they'll have a program for health workers and those susceptible in the community first. But I also suspect they'll have a program for opening up borders and travellers so they can get all economies moving around the world. And so I think that is a conservative estimate that they've got in their numbers, because the risk for us is also, and the risk for any investor in our community, is making sure that they're going into a location where they're not susceptible to having vacancies in their properties. So you've got to be mindful of that, and that's why we're always saying that the risk is in that high density, medium density stuff where there is easy risk of oversupply and also reduced rents, because you've got to attract a tenant in. So if you're going to have to drop your rents to do that, that's true. But if we lift our eyes up, we were forecasting 30 million people in this country by 2030. Now they're forecasting that could be down by 1 million, but that still means 29 million people from a base of around the 25, 26 million that we've got now, right? So that's still a healthy growth story. It still means that we need to produce hundreds of thousands of properties each year. I think the forecast now is still around 230 to 240,000 properties over the next 2 to 3 years. So that's still a material number, and there will still be people who have during the pandemic potentially gone home as they've lost their jobs, or they potentially want to get back out and socialise again. So they'll probably be looking for rental properties closer to the city to enjoy themselves and get back to a more normal lifestyle. So I think from that point of view, that still is a risk, and we've just got to be mindful of that as we invest in terms of where we're going and what future demand might be coming into that area that could put a risk on attracting a tenant over the next 12 to 24 months. I think beyond that, you're going to be quite safe. And really, that other risk is just in the the deferral scheme, Bryce. And I think it's also important just to just acknowledge that the banks are doing a very, very good job in moving people off their deferral programs. That still carries a bit of risk with it because there will be some businesses that do fail, and there will be people that you probably will see some mortgage starting to occur in that sort of first to second quarter of next year. That said, again, I'm not seeing that as being a systemic number or a big enough number that would pose a systemic risk right across all markets. When we're generalising here, but you're just not going to see. I mean, we're just not seeing it in the suburban areas where those concentrations are great enough to put a risk on prices, and because there's demand there.
Well, it's a teaching point, Ben, isn't it? Because if you are buying in a suburb where the demographic is similar, like if you do a cross section of the demographic and they're all bunched into a similar demographic, well then that's the teaching point here. Because if you've bought into a suburb that has that as a demographic profile, you have put yourself into a risky position versus pick another suburb, just slash the cross section again and see the demographic profile. There's people who have been living there for 30 years, no debt. There's people who have just got into the suburb, hocked to their eyeballs, maybe at 95%, and everything in between. So if you do have that deferral program becoming a cluster, well, if in the particular suburb that you're in, if you have that vast cross section of people within that suburb, well then the property that you have either as an owner occupier or as an investor is not at risk the same as it is in the cross section of a cluster where, you know, a particular industry or a particular demographic or a particular income bandwidth, all of a sudden there's 4 for sale signs in the street rather than 1. That's the teaching point in what you're saying.
Correct. So Bryce, why don't you just summarise for our listeners? I mean, why we think that the ducks are lining up, and we do feel that it is going to be a pretty prosperous time for property over the next 12 to 24 months.
I think quite simply, 101 supply and demand. On the supply side, not enough being built, not enough stock, therefore not enough properties on the market. And then on the demand side, I think people's ability to buy will be boosted significantly by the budget, by changes in bank policy, and interest rates almost going to zero. The cash rate almost going to zero. So you talk about one side, the supply, all right, that's pretty skinny, but then you go back on the demand side, there's not even a balancing argument. There's lots of evidence on the demand side, and importantly, anecdotally at the coalface, we're seeing it, Ben. We're seeing groups, 70s, 80s groups through, unopen, multiple offers.
And we are blessed with getting very, very up-to-date market data every week in terms of what's happening. So we've got a recovering economy that will still bump along when it needs to, but it's on the right path. We've got consumer sentiment turning. We've got a recovery in the jobs market. We're not going to get to the levels that were predicted by Treasury and the RBA in their earlier forecast. We're seeing those numbers being less in terms of the unemployment rate. We've got property stimulus through the incentive programs, the home builder packages and the home deposit schemes. You've got reduced risk in the mortgage defaults. You've got record low interest rates with the market also potentially predicting another 0.15 cut to the cash rate as early as next month. You've got responsible lending reforms. You've got, the vaccine that is going to be the story around that sentiment and potentially moving more mobility of people coming inbound to Australia, which will play itself out. You've got personal tax cuts. So that's our story on the positive side versus, the risk on the negative side in regards to maybe that population growth is going to be a little bit challenged, and there's going to be some pockets of the market that are going to be exposed from a rental point of view. But on 30,000 foot view of it, it's looking pretty reasonable that people would be looking at property as a very, very reasonable consideration for owner occupied or investment purposes over the next 12 to 24 months.
There you have it, folks. Do you agree or disagree with what we've been talking about for the last 30 to 45 minutes based on our views on the market? We'd love to hear from you. So why don't you head over to the Facebook page, let us know, go over to Instagram, let us know your thoughts, let us know what questions you have that have come out of the budget and what we've talked about today. The last couple of weeks, Ben, we've gone through some speak pipe questions. So we're getting our community to come on to the podcast, which has been so great. So I want to do a shout out to anyone who would like to go to thepropertycouch.com.au. On the right hand side, there's a widget. We're so used to doing online meetings and recording online now, Ben, so it should be second nature for all folks. So go to the Property Couch, leave a question there. We will fast track those, bring them into future episodes because we'd certainly love to know. And Ben, we've got Eliza Davies from CoreLogic coming on next week.
Yeah.
So we absolutely
get those questions in, everyone. Get
the
those
intellectual
questions
horsepower of this particular amazing professional is enormous. So don't waste the opportunity. Let us know what you want us to ask Eliza, and we will certainly ask that for you, Ben, for the community. So certainly do that. Hey, Ben, I thought we might be able to squeeze in some questions. That was ambitious. I'll roll those till a couple of weeks. You knew that. I thought maybe we'd sneak it in. But my life hack today is from one of our listeners, Ben Colin Lau, who's over in Perth. I've featured Colin before. He lives in arguably the best street in Western Australia, in Ranelagh Crescent in South Perth. It is an epic street. There's probably people in Peppermint Grove and Mosman Park and everything sort of screaming at me saying, what are you talking about? But this street is amazing. It's right on the foreshore there. So Colin has connected with me over a number of years. Listens to our podcast. This is from Colin. Hey, Bryce. Hope you, your family, and the team are all well. I'm still following the podcast and heard about your WhatsApp groceries hack from last week, Ben. Our family have been using a free app called Our Groceries. Essentially the same thing, but can also have lists for different shopping types, e.g. one for Coles, Woolies, Officeworks, Chemist, and even Bunnings. And all family members can update the list by adding or deleting items. Check it out. Check it out. Now, I think you had a sneaky look at that app as well. So I'm going to check that out. I reckon that might be worth. So thank you, Colin. And then he says at the end, he's from over in Perth. So I'm actually not sure if Colin's West Coast or Fremantle. I suspect West Coast.
Or it could be even smarter and be Collingwood.
He goes, looking forward to Ben's gloating about last night's results, which clearly I got this last week. So cheers, Colin. So thank you for that, Colin. I appreciate you contributing. I am always open to the community's life hacks, Ben. I'd love to know what's working for you so that we can share it on here. You can send me an email. You can go on SpeakPipe. Just let me know and I will share it. So, Ben, what's making property news?
Bryce, well, we obviously the show, we're keen to obviously share insights and data. Well, remember the Property Investment Professionals of Australia did a recent sentiment survey. They do this annually. So this was the sentiment survey for 2020. We're not going to go through it like we've done in the past, line by line.
Some key highlights, Ben.
But we are going to put a link to the PowerPoint presentation where you will be able to get some of those insights. So, 1,077 respondents this year. So it's a good sample size. Interestingly, 67%. Now, also I need to put this in the context, Bryce. This was taken during August and early September. So it was a difficult time, if you remember. This is where Victoria was coming into lockdown and that sort of was playing out. So we'll get some highlights in there. So 67% of people, Bryce, believed that it was a good time to invest in residential property. So two-thirds. 2 out of 3. Now, that was down from the 82% in 2019. These are obviously clever people because we know what happened in 2019. We did see property prices go very well in that area. In terms of where to buy, the locations were quite interesting. So we had regional New South Wales at 21%, regional Queensland at 18%, Brisbane at 16%, and regional Victoria at 14%. So Queensland had the majority with 36% of investor interest,
No doubt.
followed by Victoria
heading to the coastal spots of Queensland, just outside of the Brisbane City Council.
Especially when it's open.
Yes.
Well, not for borders, but if you live there, it's fine once you get in. 27%.
My wife can't stand looking at Queenslanders at the moment. She's seeing them with their tank tops on and the sun on their back, and here we are with the Kathmandus on. She just doesn't want to see another person on Instagram from Queensland at the moment.
So that's 36% for Queensland. 27 was Victoria coming in second, and 21 for New South Wales in regards to that. Now, the other thing that I found interesting in the data was we wanted to also explore how many people had done the repayment pause. So 8% of investors applied for a mortgage repayment pause during that time. And so 75% also not needing extending the original term. So even though they applied for it, they came out of it fairly quickly of those 8%. So that's also quite interesting. Some of the other key findings that we saw in there in regards to where would they buy and what type of assets would they buy. So it's pretty straightforward. It looks like people are getting the message. 74%, Bryce, said they'd buy a house. 6% said they'd buy a townhouse or villa. 5% said they'd buy a unit or apartment. 2% said they would buy a house and land package. And 5% were unsure. So we're starting to see exactly what that looks like. And finally, just to round it out, but there's heaps and heaps of data in here. I think it was over 40 questions this year. But in terms of when you're looking to buy your next investment property in the next 6 to 12 months, 44% said yes, 38% said no, 18% unsure. I suspect there was a few people sitting on the fence, Bryce, and I mentioned that in the last podcast where I said, congratulations for those who maybe did act. They may have got the bottom. But I think the window is still there for buying in Victoria, but certainly buying in Melbourne. You know, there's still a lot of economists are still thinking that the Melbourne property market will detract a little bit further. Certainly while we've got restrictions, we don't disagree with that, but I don't think it's going to stay down there for long, Bryce, giving all the indications of what's happening in the other states. So that's what Making Property News. We'll put that into the show notes so you can get access to that. And there we go. That's the property news for this week, Bryce.
It was a big property news episode, not just a segment, Ben.
Yes,
so,
true.
Thank you for that. Hey, just a shout out, if you're new to our community, I want to encourage you to go back and circle back to the first 20 episodes. I think on the official iTunes, if you're going to the podcast versus iTunes, Ben, it actually truncates some of those earlier episodes. So, but if you do it on your standard apps, you can still get access to those early episodes. But I want to encourage you to go to the first 20 and listen to the foundations. It's really, really important. The little hack here is to do it at 1.5 speed. Or if you are super time poor and you do not have a chance, listen to the little segment I do at the end of this episode. I'll tell you how to get access to the summary of the TPC 20, we call it, but it's pretty much the propertycouch.com.au/TPC 20. And you can actually download the binge guide so you can get up to speed very, very quickly. And just a reminder to folks that if you go to our Instagram or our Facebook page, whichever is your fancy, please go and follow or like us there, because we will announce our upcoming webinar first in those locations. Plus, we provide heaps and heaps of content in both of those locations, and we're going to ramp that up. Lots and lots of free stuff that you can get there. And of course, anyone who wants to go to SpeakPipe on the homepage, send us a question, let us know. We will feature you in an upcoming episode. But it's been a big episode, Ben. It's always a pleasure to hang out with you on a Thursday, as we do each and every week. But until we chat with Eliza next week, Ben.
Bryce, jobs, spend, and a budget that under-promised, that we all hope will over-deliver. So until next week, Bryce, knowledge is empowering, but only if you act on it.
Very good. Love it. See you next week, mate.
Hey there folks, Bryce Holdaway here. Before you go, if you're new to our community and only listen to maybe a handful of episodes, I thoroughly recommend that you go all the way back to episode number 1, where we unpack all of the foundations when it comes to property investing. Now, for those of you that might be a little bit time poor, I've got good news for you. We have a binge guide that you can download straight away, which summarizes the first 20 episodes where Ben and I unpack the foundational pillars of the A, B, C, D, and so much more. And you can get that straight away. If you go to thepropertycouch.com.au propertycouch.com.au/TPC20. You can download it and consume it whenever you want. It's completely free and available now. And for those of you, just a quick reminder that nothing we've spoken about today constitutes financial advice. We recommend that you reach out to your licensed professional advisor so that you can look at your unique circumstances before acting on any information. Now don't forget, go to thepropertycouch.com.au/TPC20 and get your binge guide today.